Do you want to own your dream home? Do you believe that buying a home within the bank's approved amount is safe? The answer is simple. Don't blindly accept the bank's approved amount. First, calculate your own limit. Why does that matter? This slide explains it all. Annual income, $80,000. The bank approved your mortgage. The estimated monthly payment is $2,870. That's close to 43% of your income. Think about this. Groceries, utilities, insurance, car payments, emergency funds, and federal income tax and FICA. Can you cover all of that? Let's look at the numbers. The answer is clear. The bank's job is not to protect your financial freedom. The bank's job is to lend within the range they can approve. The approved amount and the smart purchase amount for you are completely different numbers. When housing costs reach 40% or more of your income, your capacity to save and invest drops sharply, and any shock like job loss or medical bills can destabilize your finances overnight. This is a trend the historical foreclosure data makes clear. Foreclosures stem from a combination of factors: job loss, rising interest rates, medical expenses. But when housing costs are already high, your resilience against any shock is dangerously low. And this is avoidable. Know the 28/36 rule. Target keeping your housing costs at or below 25% of your income. This single decision dramatically changes your financial safety margin. Today, let me show you the math behind it. Have you heard the term house poor? Literally translated, a homeowner who is broke. This isn't just a metaphor. U.S. housing statistics have a clear benchmark for this. When housing costs exceed 30% of income, you're cost burdened. When they exceed 50%, you're severely cost burdened. This is the definition used in U.S. Census Bureau data. In today's video, we'll treat anything above 50% as the danger zone. But don't forget, the financial pressure on your household begins the moment you cross 30%. What does exceeding 50% look like on a monthly income of $6.667? Over $3.334 vanishes on housing alone. You're left with $3.333 to cover food, utilities, a car, insurance, and medical expenses. And income taxes and FICA still have to come out of that. One unexpected expense collapses the entire financial picture. That's the reality of being house poor. The house exists, but financial stability is gone. The 28/36 rule. Have you heard of it? This is a long-standing guideline for household financial safety. The rule is simple. Your housing costs, principal, interest, property taxes, and insurance combined, must stay at or below 28% of your gross income. Your total debt, car loans, student loans, credit cards, everything must stay at or below 36%. Now, what does the bank look at? DTI, debt-to-income ratio. But the bank's acceptable DTI varies depending on the loan product, government guarantee type, and the borrower's profile. It's not a flat 43% maximum across the board. The critical point: bank underwriting standards are not asking, can you afford this safely? They're asking, is there a chance you can repay this? What happens when you apply the 28% rule to an $80,000 annual income? Your monthly gross income is approximately $6.667. The 28% ceiling comes to $1,867 per month. That's the number you take into your home search. Even if the bank says you qualify for more, your limit is $1,867. The difference you redirect to investments every month becomes the foundation of long-term wealth. Let's run the real numbers. Annual income, $80,000. Gross monthly income pre-tax is approximately $6.667. But here's what you must understand. In the U.S., that $6.667 does not land in your account intact. Federal income tax, state tax, and FICA. Combined, roughly $1, $500 to $1, $600 is withheld each month. Your actual take-home pay is approximately $5,000 to $5, $200 per month. Every calculation must be built on that take-home number. At current interest rates, approximately 7%, The principal and interest payment on a $350,000 mortgage is roughly $2,330 per month. Add property taxes and insurance, and you're at $2,800 to $3,000 per month. Add maintenance reserves and HOA fees, and total housing costs approach $3,200 per month. Subtract $3,200 from $5,100 take-home, and you have roughly $1,900 left. Food, transportation, utilities, and everyday expenses run $1,500 or more per month. You're left with about $400 per month. Can you invest on that? Can you build an emergency fund? The answer is clear. Do you know the true cost of homeownership? Most people look only at the monthly mortgage payment when deciding to buy. That's the first trap. In the U.S., the standard framework for housing costs is called PT. That's principal and interest, taxes and insurance combined. On top of that, add maintenance reserves and HOA fees. For maintenance, 1% of purchase price per year is sometimes cited as a baseline, but that's the floor. For older properties, professionals recommend budgeting 2% to 3% annually. On a $350,000 home, that's $3,500 to $10, $500 per year, or $292 to $875 per month. And right now, the 2024-2025 market carries specific risks you can't ignore. The 30-year fixed rate has been running in the 6% to 7% range according to Freddie Mac data. On top of that, climate-related risk has driven homeowners insurance premiums up more than 20% year over year in certain regions. This is not just a Florida or California issue. Insurers are exiting specific markets entirely, and when that happens, forced placement into high-cost policies can send your premiums through the roof. In today's market, confirm two things before you buy: the actual interest rate at the time of purchase, and a real insurance quote for the specific property. Without those two numbers, your calculations are worthless. Do you understand the concept of opportunity cost? It's the value of the alternative you give up by making a choice. Say you're paying an extra $1,000 per month toward your mortgage. That's $1,000 that never enters your investment account. Let's look at the numbers. If you invest $1,000 per month at a nominal pre-tax rate of 7% annually for 20 years, what's the rough result? Approximately $520,000. Fees, taxes, and market fluctuations will shift that number, but the difference between investing and not investing is unmistakable. Follow the 28% rule, and that $1,000 flows into investments every month. Take out a loan at 43% of income, and that $1,000 disappears every month. Choosing a $350,000 home versus a $250,000 home today is not a real estate decision. It's a decision about what your financial position looks like 20 years from now. Face reality. In today's market, finding a property that keeps you within the 28-36 rule may be difficult. But overstretching for an expensive property is far worse than increasing your down payment, adjusting the property, or continuing to rent, all of which beat going broke. So how do you buy a home without becoming house poor? There are 4 steps. Step 1. Lock in your budget first. Before you talk to a bank, calculate your own ceiling. Take your gross monthly income, pre-tax, and multiply by 25%. That's your target upper limit for housing costs. On an $80,000 annual income, gross monthly is approximately $6,667. 25% is $1,667. That's the number you take into your home search. Even if the bank says you qualify for more, your target is $1,667. Step 2. Get to 20% down before you buy. Put down less than 20%, and you'll typically be required to carry PMI private mortgage insurance. The monthly PMI cost varies based on your credit score and loan-to-value ratio, but the additional expense is guaranteed. On a $350,000 home, that means $70,000 or more as a down payment. Don't rush to buy before you're ready. Step 3. Calculate your true cost using PITI plus maintenance plus HOA. Don't look at the loan payment alone. Add property taxes, insurance, maintenance reserves, and HOA fees. Always use the actual current interest rate and a real insurance quote for the property in your calculations. Never run numbers on outdated assumptions. Step 4. Run your final check against the 28-36 rule. Are housing costs at or below 28%? Are total debts, car loans, student loans, everything, at or below 36%? Only when both answers are yes do you sign the contract. Now let's bring today's key points together. Here's today's summary. First, run every calculation on take-home pay. An $80,000 annual salary means $667 gross per month. But after federal and state taxes and FICA, take-home drops to approximately $5,000 to $5,200. If you calculate housing and living costs against the gross number, your estimate of what's left will be fundamentally wrong. Most people make this mistake. Second, confront the opportunity cost directly. The difference between the 28% target and a 43% loan is $1,000 per month. Invest that $1,000 monthly at a nominal pre-tax rate of 7% for 20 years, and you're looking at approximately $520,000. When you choose the expensive home, what you're sacrificing is the opportunity to invest that money at all. Third, calculate true costs using current numbers. Don't look at the loan payment alone. Add PITI, maintenance reserves, and HOA. From 2024 into 2025, rates have been running 6% to 7%, and insurance premiums in certain regions have climbed more than 20% year over year. Before you buy, confirm the actual rate and get a real insurance quote. Numbers built on outdated assumptions are worthless. Are you currently considering buying a home? Or are you already feeling the weight of your housing costs? Share your numbers and situation in the comments. Your questions, your calculations, your experience, all of it becomes the collective intelligence of this community. If today's video added value, subscribe to this channel. Every week, I break down the house poor trap, asset allocation strategy, and take-home-based financial freedom design with real numbers every time. If you want to protect your financial future with numbers instead of emotions and blueprints instead of dreams, subscribe and turn on notifications. See you in the next one.